An ETF, or exchange-traded fund, is like a basket of investments, stocks, bonds, or other assets that you can buy and sell on the stock market just like a regular stock. ETFs are designed to track an index, sector, or specific investment theme, allowing investors to gain exposure to a variety of assets in a single purchase. Since ETFs trade throughout the day on the stock exchange, their price constantly changes based on supply and demand. They are known for being cost-effective, tax-efficient, and flexible for investors who prefer hands-on control over their investments. On the other hand, a mutual fund is another type of investment fund that pools money from many investors to buy a diversified portfolio of stocks, bonds, or other assets. However, mutual funds are actively managed by professional fund managers who aim to outperform the market by making strategic investment decisions. Unlike ETFs, mutual funds don't trade on an exchange during the day. Instead, they are bought and sold directly through an investment company at the fund's net asset value, NAV, which is determined at the end of each trading day. Mutual funds often come with higher fees due to professional management, and they may have minimum investment requirements. Now, let's compare ETFs and mutual funds side by side. First, trading flexibility. ETFs trade like stocks, meaning you can buy or sell them anytime the market is open. Mutual funds, however, only allow transactions once per day after the market closes. If you want more control over your investments and like the ability to make quick trades, ETFs win in this category. Next, let's talk about costs. ETFs generally have lower expense ratios compared to mutual funds because most of them are passively managed, simply following an index instead of relying on expensive fund managers. Mutual funds, especially actively managed ones, tend to have higher fees, which can eat into your returns over time. In terms of cost effectiveness, ETFs are the better choice. What about taxes? ETFs are usually more tax efficient than mutual funds due to the way they are structured. When you sell an ETF, you only pay taxes on your own capital gains. But in mutual funds, when the fund manager sells assets inside the fund, those capital gains may be passed on to all investors, even if you didn't sell anything yourself. This can lead to unexpected tax bills, making ETFs the clear winner in terms of tax efficiency. Now, let's consider accessibility and minimum investments. Many mutual funds have a minimum investment requirement, sometimes starting at $500 or even thousands of dollars. ETFs, on the other hand, have no minimum investment beyond the cost of a single share, making them more accessible for beginners and small investors. If you're just starting out, ETFs provide more flexibility. Lastly, let's talk about management style. Mutual funds often have professional managers making investment decisions, which can sometimes lead to higher returns in certain market conditions. However, studies show that most actively managed mutual funds fail to consistently beat the market after fees. ETFs, being mostly passive, match market performance rather than trying to beat it. If you believe in professional management and don't mind paying higher fees for potential outperformance, mutual funds might be appealing. But for most investors, the simplicity and lower cost of ETFs make them the more practical option. So which is the better choice? For most people, ETFs win. They are cheaper, more tax-efficient, easier to trade, and more accessible. However, if you prefer professional management and don't mind higher fees, mutual funds could still be a good choice for you. It all depends on your investment goals and strategy.